This deal looks like a cash machine, but when you actually break it down, it is not as good as some people think, depending on your circumstances. I am starting a new series where I take real UK property deals and break them down properly. There is no fluff, no estate agent spin, just the real numbers, the real risks, and whether I would actually buy it or not. This one is a 7-bedroom HMO in Wembley. The rooms are renting between £600 and £850 per month, which brings the total income to around £4,850 per month, or just over £58,000 per year. On the surface, it looks like a strong deal, and this is exactly where most people stop their analysis. But surface level numbers do not mean much, so let's run it through core. With cash flow, on paper, this is sitting at around 9% gross yield, which is the kind of number that gets people interested very quickly. The problem is that gross yield does not tell you what the deal actually puts into your pocket. With a 7-bed HMO, the running costs are going to be heavy. You are covering utilities for multiple tenants, including gas, electric, water, broadband. Maintenance is ongoing because shared houses naturally experience more wear and tear. And if you are not managing the property yourself, you will also be paying high management fees. So while the income looks strong, the reality is that the net profit is much tighter than it appears at first glance. Moving on to operations. This is where the workload really shows up. You are dealing with 7 separate tenants, which means 7 different people, 7 different expectations, 7 potential sources of issues. This is not a passive investment. You have tenant communication, room turnovers, cleaning, inspections, and on top of that, you have licensing requirements and ongoing compliance. Literally, if anything goes wrong, you are the one responsible for sorting it out. Looking at risk, there is some strength in the fact that the income is spread across multiple tenants, so one person leaving does not immediately damage the entire deal. However, the trade-off is higher turnover. Rooms will become vacant more often, new tenants will need to be found, and the property will experience more consistent use and damage. There is also regulatory risk. HMOs are constantly under pressure from local councils, and rules can change, standards can increase, and costs can rise. When that happens, your margins can shrink very quickly. When it comes to exit, this is not a standard property that appeals to the open market. You are not selling a typical homeowner, you are selling to another investor. That means your exit depends heavily on investor demand. If demand is strong, you are in a good position. If the market slows down, your pool of buyers becomes much smaller. So for me, this is not a clean deal. I would class this as an adjust. It is not a bad deal, but it is not something I would move forward with in its current form. For this to make sense, I would want to improve the structure. That could mean increasing the income through better room layouts or higher quality finishes, or reducing costs and tightening the way the property is managed. Without those changes, you are putting a significant amount of effort for a return that does not properly compensate you for the level of risk and involvement. The key lesson here is simple. High income does not automatically mean a good deal. What matters is what you actually keep, how difficult the property is to run, and how exposed you are to changes in the market. If you want me to break down a deal like this for you, I offer core deal audits. There is a form in the description where you can apply, and I will go through the numbers properly and give you a clear view on whether the deal actually works. I will keep breaking down real deals like this, so if you want to understand what actually makes a property perform well, make sure you are following along. So having reviewed this property, what are your thoughts? Would you invest in this deal?